Hello and welcome back to the channel. If it's your first time with us, my name is Alex. I'm your Hawaiian guy here in Canada, trying to help you, the new investor, grow your portfolio in a safe and healthy manner. We talk about all things regarding investing. I try to make terms a little easy and simple to understand for individuals that are just getting into the market. I answer any questions you might send me in the comment section, but above all, we try to have a good time. If that sounds like something you're into, do me a favor, become part of my family. Hit that subscribe button, hit that like button, and let's grow together. All right, guys, let's get into it. All right, let's get into today's video. In today's topic, I want to talk about, are dividend paying stocks a good thing to invest in? How much should you invest your portfolio in these dividend paying stocks, and how much do you actually need to retire? We're going to get into all three of those points in this video today. The first really important thing I want you to remember are dividend paying stocks is not something that's guaranteed. Companies at any time can stop paying these dividend funds. And last year, when the pandemic really kind of hit back in March or April, two big companies that stopped paying dividend funds. One was Delta Airline. They flat out just stopped paying. And another one was Walt Disney. They didn't pay the first half or the first couple quarters. I'm not sure if Disney has continue to pay again. If you do know, please hit me up in the comments. But if you had your portfolio kind of 60% of your portfolio dedicated to these two particular stocks, you got hit quite hard in 2020, which is why I always say one of the most important things to build a healthy portfolio is diversification. You really want to have an amalgamation of different companies together, just in case one particular sector gets hit really bad, you still have these other sectors to kind of hold you afloat. And what I mean by that is you want to have maybe some REITs, which are real estate investments. You want to have a little IT, maybe a little EV, a little biotech sprinkled in, maybe a little blockchain technology, maybe a little hospitality, maybe hotels. You really want to have a really diverse portfolio. That way you're not getting hit hard when any particular correction happens in the market. Like I mentioned before, there are some kind of like blue chip stocks that are, I hate to say recession proof, but they hold up very well during corrections in the market. And one particular stock, which is really great for us here in Canada or individuals abroad as well, you're more than welcome to buy our stocks. Thank you very much, is Bell Telecommunications, ticker BCE. Right now, they're paying dividends of about $3.33 per share with a dividend yield of about 5.98%. That is a really solid company. I want to say for the last 20 to 25 years, they've been paying their dividends consecutively. They have never stopped, even during the dot-com bubble as well as the housing crash in 2008. They have consistently paid their dividends. The one kind of downside of companies like this, you don't see a lot of growth in the stock. I think back in 2000, Bell Telecommunications was trading about $45, $46 per share. And when I looked this morning, I think they were trading about $54 a share. So you see in the last 20 years, they haven't gained much, but actually their dividend payments have actually increased over that time period. Now you can look at this as a positive and a negative. To start off with a negative, if companies are paying you large amounts of dividends, they're not really reinvesting back in the company with innovations, with new ways to actually grow the company. They would rather just pay you, the investors, for being part of their institution. That can be a bad thing, that can be a good thing. So when you look at companies like Amazon or Tesla or Apple, if they do, any companies that are like that in the tech that's really trying to grow, they tend not to pay you too much in dividends, because what they're doing is they're reinvesting that money into the company and trying to grow the company larger. And those are the stocks that you tend to see that'll jump 10 or 20 or 30 or 1,000%, because they're taking their money and reinvesting it back in the company instead of paying you dividends. So you kind of got to think, do you want to be on the innovative side with companies like Tesla and Apple and Google, or do you want to be on the safe side with like S&P 500s like Vanguard or BMO, Bank of Montreal, or Bell Telecommunications? So the best thing, what I would do, I'm not telling you to do, because it's always your responsibility to make sure the stocks that you purchase are something that you have great interest in and you have faith in and confidence in. But what I would do personally, I would get a little bit of Bell Telecommunications, a little bit of Vanguard Holdings, a little bit of Apple. I would kind of spread it across the board. And for a lot of you new investors, and maybe you're just not really sure how to pick a stock yet, go on the safe side, as safe as can be, and choose a Vanguard stock like a ticker VOO or VTI. Vanguard Holdings. That way you get a little bit of Tesla, a little bit of Apple, a little bit of Microsoft, Facebook, PayPal. You get the best 500 companies in that one stock. That is really, really great for a lot of you new investors. So now come down to the question, Alex, how much money do I need to retire? Again, this is one of those questions that really depends on you and what type of lifestyle you're going to need when you retire at 50 or 60 or whatever age you decide to retire at. I'm going to show you a formula that kind of helps make it a little bit easier to see what goal you need to save to retire at a certain level. So there's a pretty simple calculation to do this. For simplicity, let's just say out of the 10 companies or 20 companies you have in your portfolio, your dividend yield average is about 3%. Okay, so stay with me here. Say you want $50,000 a year of dividend money coming into your pocket. What you would do is divide $50,000 by 3%. But one moment, not actually 3%. What I want you to do is take that decimal point and move it over 2 spaces. So actually what I want you to do is divide 50,000 by 0.030%. Did you get that? So if it's 3%, you move that decimal over twice. Okay? So it would be 50,000 divided by 0.030%. And you would come out to roughly about $1.66 million. So you would need about $1.66 million to retire with about $50,000 a year. Now again, if your average is 4%, you just have to calculate and it'll show you a different rate which you would need. Now I know a lot of you guys are sitting there thinking, dude, how am I going to save $1.66 million? It's a lot easier than you think. Or, I wouldn't say the word easy, but it is definitely doable. If I tell you, hey, I want you to walk 1,000 kilometers starting tomorrow, and you think to yourself, man, I can't walk 1,000 kilometers. That's 3/4 of North America. Okay, I get it. But imagine you walked 1 kilometer a day for 1,000 days. It might take you 3 years or so to walk that 1,000 kilometers, but it is definitely doable. The same thing goes when you're investing your money for retirement. You're not going to save $1.6 million in the next year or two. It's going to take you 15, 20, maybe 30 years to save that. But I guarantee you, if you're 25 or 30 now and you start consistently putting 1,000 or 1,200 or whatever you can put, it doesn't matter if you put $50 or $100, that money you're saving now will make life so much easier down the line. So my point is, I understand not everybody can invest $1,000 a month. Not everyone can invest $500 a month. Maybe you can only do $50 a month. But the one magical thing that a lot of people tend to forget is compound interest. And you would be amazed how much money you can actually make from compound interest. 20 years from now, you're going to look back at yourself and say, hey, I'm really glad I listened to that Hawaiian guy in Canada. He really made my life a lot easier. All right, guys, again, the information I give you on this channel, different individuals in different situations, it might work differently, but the vast majority of the time, you do far better by investing in the market versus buying a savings bond or just putting your money in the bank or investing in a brand new sports car that you hope will gain value or even getting a new Pokemon card that might triple or quadruple in value. Investing in the market statistically is the better way to grow your wealth over time. And I know I'm going to get a lot of comments, well, how about buying real estate? Great. If you can find real estate and at a good price, then I would definitely say go for real estate. But I know here in Canada, they typically say don't purchase real estate more than 3 times what your salary. I think the median income here in Canada is about $52,000 to $55,000. Good luck finding a home for $150,000 to $200,000. Even in the most rural places like Saskatoon, Saskatchewan, you're not finding a home for $200,000. It might be easy for you folks in the States or otherwhere around the world, but here in Canada, real estate is extremely expensive. And One thing I typically don't like about real estate, one is really expensive here in Canada, but it's not liquid. And putting your money in the stock market, you can actually pull it out within a matter of 48 to 72 hours, versus purchasing real estate. That takes months and paperwork and lawyers and contracts and many different things. If you like this video, do me a favor, hit the subscribe button, hit that like button. I want to hear your comments. What do you think about the information here? I hope it was helpful, and until the next video, aloha.